China refines 2/3 of the world's silver. They're net importers of silver now. So it means that China is 2/3 plus taking all of the silver for their industry. They're not letting it go. They're like, hey, we'll refine it, but then they don't sell it. And so I think within the year, we're going to have an acute silver shortage around the world because China's hogging a bunch of it. And I mean, what's the US going to do? It's a critical mineral, but have we permitted any new big mines? Not yet. So yeah, the East is taking over the gold and silver trade, and eventually that pricing duopoly between COMEX and LBMA is going to fall. It's just a matter of time. And I think the East is going to have much more, and the Middle East as well, is going to have much more credibility with respect to precious metals than the West will.
Global financial dynamics are rapidly shifting as physical precious metal reserves move from Western vaults toward Eastern markets. Strategic industrial demand and central bank accumulation are threatening traditional paper-based pricing systems. Rob Kientz, a respected precious metals strategist and financial analyst, highlights that China's aggressive hoarding of silver is rapidly destabilizing Western exchange dominance. Because China refines over 2/3 of global silver and retains every ounce for its domestic industry, an acute worldwide physical silver shortage is predicted to erupt within the year. Meanwhile, Western exchanges like COMEX face unprecedented physical inventory drains as registered gold and silver vaults fall toward emergency levels. As BRICS nations construct physically settled trading hubs through Singapore, Hong Kong, and Dubai, the historic paper pricing duopoly between London and New York will inevitably collapse. Institutional credibility is migrating east, leaving Western paper markets severely exposed. Now we present the clips from Rob Kientz's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Investor confidence is going to go east because if you look at the liquidations on COMEX for gold and silver, we are down 9 or 10 million ounces of gold registered and eligible. We're down to 100 million ounces of registered silver. This is after a big buildup in silver in 2025. So we're being drained. You're seeing that physical trade move over to the east through Singapore, Hong Kong, China. Even Russia's getting that. Russia's trading 3 times as much gold in their market as they were before. So the BRICS nations are enhancing and building infrastructure around their gold trade, and they're starting to have a lot more credibility. They're closer to what the physically settled price should be because they actually settle physically. Dubai does as well. And the West is a paper-driven market in which there are large interests that manipulate that market for their purposes, both financial, banking, and other large players. So I think, Lucian, the Western market, what's going to happen is people are going to look at that like a fugazi. They're going to look at that like you have nothing to do with the trade. Why do we care? And in the East and in the BRICS nations, you're seeing them embrace the physical and say the physical is important. And China's building ETFs for the retail segment so that retail investors can get in. I don't know if there's going to be convertibility, but it doesn't matter because that ETF is going to suck gold out of the trade market. So China has developed a mechanism to not only suck all the gold and silver in, but then to have marketplaces that they control, their portion of the gold, who it goes to, and that's going to dictate prices on that side of the world. And we're getting to what I said last time is regionalized markets. And they're going to have a lot more credibility with actual gold market participants than New York or London has. New York or London, it's like the clothes are off the emperor, right? We see you're naked. And I don't think people trust it as much. And once the COMEX finally runs down to emergency levels of gold and silver, which is what's happening, it will eventually happen if China and the BRICS nations' appetite for gold and silver is so strong that they're taking all available inventory, the COMEX will not survive in its current form because it's being drained.
Yeah.
And China, one other thing I want to say about China, China refines 2/3 of the world's silver. They're net importers of silver now. So it means that China is 2/3 plus taking all of the silver for their industry. They're not letting it go. They're like, hey, we'll refine it, but then they don't sell it. And so I think within the year, we're going to have an acute silver shortage around the world because China's hogging a bunch of it. And I mean, what's the US going to do? It's a critical mineral, but have we permitted any new big mines? Not yet. So yeah, the East is taking over the gold and silver trade, and eventually that pricing duopoly between COMEX and LBMA is going to fall. It's just a matter of time. And I think the East is going to have much more, and the Middle East as well, is going to have much more credibility with respect to precious metals than the West will. The Clarity Act is changing the House version. The House version was the Anti-CBDC Surveillance Act. Listen to the language. anti-CBDC surveillance. Anti-CBDC because they don't want a digital currency that the government controls, and it's considered surveillance. Why? Because you can track everything with it. They were acknowledging the surveillance aspects of what a CBDC could do. This is the US government. This is the US House. And the US House is the part of the bicameral legislator, the two-part legislator that closely represents the people. Their remit is to argue for the people, whereas the Senate represents sort of the state interests, in the union. And that compromise came about as a result of Federalist and Anti-Federalist in the Constitution and all that stuff, right? So we have the House representing the people saying, we don't want digital currency and we don't want the surveillance that comes with it, the government surveillance that comes with it. Well, the provisions have been changed in the Clarity Act to where the Clarity Act actually introduces more regulatory frameworks like the SEC and FinCEN, which is good. But what it does do is it reinstates the possibility that the U.S. could implement a national CBDC. Now, the only restriction in the Senate bill is that an individual in the government can't institute a CBDC. But honestly, if the Senate lead says, I want to create a CBDC and nobody agrees with him, it's not getting rid of any risk. It's saying that if you're Trump or you're Pelosi or you're any one of these people in a legislative or executive position, or even a Supreme Court justice in that branch, that you cannot implement your own CBDC. Well, nobody would buy that anyway. Like it's what risk are you getting rid of? I mean, if we had a dictatorship, but we don't.
Yeah.
So, but it opens it up for Congress to implement legislation that could bring in a CBDC or a suite of stablecoins acting as a central bank digital currency. In gold. Let's say the central banks buy up all the gold. And so it's not widely available to the people. And then they implement a CBDC. The gold that they're buying is not just because gold's a tier one asset in Basel III that supports the banking system. The gold that they're buying is to keep it out of the hands of the people. He who has the gold makes the rules. If the central banks get a big enough chunk of the gold, they make monetary rules. They will own the monetary system and governments around the world. And it will be control in the hands of a smaller group of people, financial technocrats, and not in the broad base of duly elected representatives to each parliament, Congress, executive branch, all that kind of stuff. That's my conspiracy theory. But remember, I've been taught to think like an attacker. How would I attack the system and gain control? This is how I would attack the system and gain control and get the people to participate in building their own prison, financial prison.
Yeah,
If I wanted to do it, this is how I would do it. I'm not saying that that's
Sure.
their intent. I'm just saying this is how I would do it if I was thinking like an antagonist or attacker. How do I gain control of this? Well, this is how I would do it.
Legislative developments surrounding central bank digital currencies reveal growing tensions between government surveillance and financial independence. While legislative frameworks attempt to restrict standalone digital currencies, central banks are silently accumulating massive gold reserves to secure monetary power and keep tangible assets out of public hands. Concurrently, a complete separation has emerged between paper spot prices and physical trade reality. Western derivative exchanges rely heavily on leveraged futures contracts, whereas Eastern markets actively restrict paper speculation to back their trade with physical metal. Forecasts indicate that as paper vault reserves hit critical minimums, Western derivative exchanges will fail to survive in their current form. Driven by Eastern industrial appetite and national export restrictions, the market will experience an unavoidable, severe physical silver deficit across global supply chains within the year. Now, let's get back to the interview.
The gold and silver market's an interesting one. You do have the seasonal demand fluctuations. So in summer, typically gold goes down, gold and silver, or I would say on the pricing, I'm going to separate pricing and physical because now they're so separated. You can't say the gold market. There is no gold market. There's a physical trade and then there's the pricing markets. And they're not always, looking at the same thing. So the pricing market, there is a lull in the summer, typically in gold and silver, and typically around the end of August or through September is when you start to get a rebound. And it's really good usually through February, March. And then as the late spring and summer comes, people kind of float away from those markets like they do a lot of financial markets. And so the seasonal demand is part of what's going on. But we had the big crash, right? So we had a big crash and we've had this big correction. Silver's down to slightly less than half of what it was. Gold's not down quite so much, but it's down about, a third-ish, or a little bit more than a third. So those are significant corrections, but the reasoning for gold and silver, having gold and silver as an asset, and even treating gold and silver as money when the banking system are still there, you've still got the central banks buying the gold, and this is where we get into the physical. So you've got to separate price mechanics.
Of course.
The reason people were selling off in gold and silver was they had launched up quite a bit, and the market needed to rest from a technical perspective. Because remember, in the US, spot prices are almost entirely determined by COMEX futures.
Yeah.
And only about 0.5% of those futures contracts, those bets, and they're usually about 2 to 3 months in length, sometimes 6 months. You can go out longer, but people are betting what the price is going to be 2, 3, 4 months out, kind of like they do with oil and all these other markets. And sometimes they're wrong. And with only 0.5% of these contracts delivered, Lucian, it's not a physically determined market. So what drives my interest in gold and silver is how the supply demand is going, and specifically how the big entities in the world are treating gold and silver. So the central banks are still buying it hand over fist. You did see some selling by Turkey and another European central bank, can't remember which one, because of distress, because of currency distress. Turkey's going through a currency distress, and they're selling an asset which will help them deal with that. That's what the gold is for. But remember, Turkey's locked down exports of gold. They will not let it leave. They're one of the top 5 gold markets in the world. Gold is a huge part. I was over there last year in Istanbul talking to the director of the gold market there in Istanbul. I know that gold is he told me the people there still think of gold as their primary currency, not the Turkish lira, I believe it is. So they've locked down. That tells you how they value gold. Now they're selling some, but that's because they're in a currency crisis. And that's what gold is for. Gold is serving its purpose. When your fiat currency goes into crisis, what do they use to recover from that? It's the gold. And that's in the top 5 gold market in the world. Going beyond the central banks, if you look at what's going on in Asia, China and Hong Kong have come to an agreement on the Hong Kong Gold Gateway. Hong Kong is a huge market for gold and silver. They're a huge jewelry producer. They also do industrial grade bars in gold and in silver.
Yeah.
And a lot of the previous Chinese exports would go to Hong Kong for making in jewelry, and then most of it would go back to China. Well, now China has just formalized, and Hong Kong have formalized that relationship and said, okay, well, heck, let's build a system that links Hong Kong's gold trade and vaults with Chinese manufacturing. And they have a system, a information system for that. And now they're in an agreement that they're going to join forces. And this, if you remember previous episodes, I probably talked about this, I would imagine. 5 or 6 years ago, when I was at Silver Symposium in Coeur d'Alene, Idaho, which is an industry conference here in the US, was at the time the longest running one. I reported that it was in the news. I believe it was Business Insider that had reported that China had engaged JP Morgan as a consultant for their commodities, not only gold and silver, but their commodities, the Shanghai exchange, the broader exchange. And so now China's kind of gone through a redevelopment of the Shanghai exchange, and a lot of things have happened. You've got the export restrictions on silver. Now you have to be a licensed, government approved organization to export silver. So China's wrapped its, government branch around the silver trade. They have also, there is an approval process for getting on the Shanghai exchange. China's removed most of the paper trade. So if you look at the London market, the LBMA, and you look at the New York market, the COMEX, they're primarily a paper-driven market. China has locked it down to where 50% of their trade on their markets has to be in gold, and they've removed retail exposure to futures trading, meaning they're removing paper, they're removing people out of their gold market that don't either produce it, use it, or are manufacturing it or mining it or whatever. And so the leverage trade in Chinese market's been shrunk. And in the US, conversely, we now have a 24/7 trading futures contract that cannot be delivered in physical. We also now have hyperliquid trading 24/5 in Kalshi. Kalshi, the big trading platform, has now applied for a 24/5. So 5 days a week, all 24 hours, Monday through Friday.
Yeah.
Trading of the futures market. And guess what? You don't have to have gold to trade it. So the US is moving to almost a completely derivative driven market where physical has nothing whatsoever to do with prices. And LBMA is already there. They're already leveraged 100 to 1, according to most analysts who actually live on that market. And then you've got China going the opposite direction, saying, we want more of the physical trade. Not only that, we're going to do these partnerships around Asia. Now in Singapore, the Singapore market is developing futures markets for gold and silver. And so that now that you can have the Shanghai Futures Exchange, because there's two Shanghai exchanges, the physical and the futures. So China does have futures, but they've cordoned it off from physical. Okay. So you can play futures in China, but it's not dictating the price of Chinese gold.
Seasonal lulls in precious metal pricing frequently mask the profound structural realignments occurring within global commodity markets. The growing disconnect between paper futures pricing and physical metal settlement highlights a failing Western financial architecture. While platforms in the West expand derivative trading to 24/7 hyperliquid contracts detached from real delivery, Eastern powers are systematically fortifying their physical supply networks. The formal integration of the Hong Kong Gold Gateway with mainland Chinese manufacturing exemplifies this shift toward localized, asset-backed ecosystems. Central banks are aggressively acquiring gold to reinforce Basel III balance sheets and maintain exclusive control over monetary frameworks, effectively shifting power into the hands of financial technocrats. Consequently, Western exchanges like COMEX and the LBMA will lose their price-setting authority as vault inventories drain to crisis levels. With refining heavyweights imposing strict export licensing to preserve domestic silver supplies, global markets are projected to face an acute, unprecedented silver shortage within the year. Ultimately, credibility and market influence will reside in physically settled regional hubs rather than leveraged Western paper markets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.